Good afternoon, everyone. I hope everybody's well and staying safe wherever you are in the country. Today, I'd like to welcome you to the Association's webinar series. And we have 4 panelists from our business advisory and accounting partners, HLB Mann Judd. I'd like to welcome Andrew Ash, Nicola Morgan, Todd Gamble, and Nicholas Guest, who will be presenting today. During the presentation, if you have any technical issues, please type something in the chat function and we'll do our best to resolve those. There will be a question and answer session at the end. And again, use that chat function there. Put your questions in there and we'll run through the questions and answers at the end. And you'll notice there'll be some live polling as well during the presentation. So I think that's everything from me. It gives me great pleasure to hand over to HLB Mann Judd this afternoon. And first off is Nicholas Guest.
Thank you, James, and welcome everybody. This afternoon, we are going to explore some of the challenges and the opportunities as we see them for the road ahead, and what we can each do as business owners and operators to try and place ourselves in the best possible position to potentially weather some storms, but also take advantage of some opportunities as they present. As James mentioned, we're going to have 3 panelists talking this morning, or this afternoon now. It's ticked over here in New South Wales. Myself, I'm a partner within the Assurance and Corporate Advisory team at HLB Mann Judd. Andrew Ash, who's a manager within our Business Advisory team, and Todd Gamble, who is a Restructuring and Risk Advisory partner. So, to set the scene, and if we just move on to our next slide, we are, as I mentioned, going to explore some of the challenges and opportunities. And before we kick off, I'd like to ask each of you to consider our polling question here, which is, when considering the outlook for your business and industry for the remainder of the 2020 calendar year, as at today, and then compared to last month, how do you feel? And do you feel that there's improving confidence for you and your business in the outlook, or that you'll struggle and face some challenges? So I think our polling question may pop up. I'm not sure if that is up there at the moment. And we might just move on. We thought we'd just set the scene a little bit, and it is only 4 weeks old since the federal government provided their fiscal update, their sort of typical mid-year position, but a lot has changed since then. Some of the headline numbers which you would have picked up at the time was obviously the expected deficit is going to grow out to $85 billion, up to $184 billion next financial year, which is a huge number. Likewise, we'll see a huge growth in the federal government debt. Our GDP is expecting to contract in this current year, but in a positive note, they're looking for a growth, or were expecting a growth in GDP in FY21, which is a good sign. Concerning was the unemployment numbers, where they were anticipating that an additional 500,000 Australians would be unemployed at Christmas 2020 as compared to Christmas time in 2019. So that's obviously a concern. What is critical, or was critical to their assumptions, which I believe now are going to prove pretty challenging, was that the Victorian lockdowns which were occurring at that time would have been somewhat lifted as of today. But as we know, that those in Melbourne and parts of Victoria were subjected to the stage 4 lockdowns quite soon after this budget was announced. So that's going to prove challenging for these budget outcomes to be achieved. Likewise, there was an assumption that some level of international travel would be commencing again from 1 January 2021, which may also prove to be optimistic. I think it's largely desirable for large parts of the population and from a business perspective to free up and have some level of international travel occurring again. But I think from the health outcomes that we might see that those lockdowns or that restrictions on travel extended. If we move on to the next slide, there were some positives to take from this outcome, and as we said, that I think it looks pretty positive that they are forecasting some level of growth in the economy in 2021, and would like to think that there's going to be some recovery, coming through at that point in time. The government is also very committed to supporting jobs and supporting businesses. So there's a continuation of those stimulus packages. And subsequent to this budget, there were some further tweaks to those stimulus packages, which Andrew will explore shortly. And so, I mean, I guess our summary outlook from this is that business conditions are going to prove pretty challenging over the next 12 months for some sectors of the economy. But with that, I think there is also opportunities, and if each business is able to assess their position, they're able to consider their opportunities and potentially respond best to the challenges that are presented to them, and then they'll be best placed to potentially weather the storm or potentially even sort of evolve their business further. And that's some of what we'd like to set you on a path today. So with that, I would like to hand over to Andrew Ash, and Andrew is going to run through some of the continued incentives and stimulus packages that are available for business. Thanks, Andrew.
Okay, thanks Nick. So as Nick said, I'm a business advisory manager here at HLB Mann Judd. I specialise in, I guess, assisting private and family-owned businesses with accounting and tax. And I'm going to, today I'm going to discuss with you, two of the government's stimulus measures. Firstly, the JobKeeper, and then secondly, I'll touch on the instant asset write-off. Okay, so let's get started. So next slide. So you may or may not know that the government has extended the JobKeeper to the 28th of March 2021 with some changes to the legislation. But I suppose it's probably worth noting at the outset that not everything has changed. So let's go through, the things that haven't changed. So firstly, there's no change to the JobKeeper up until the 27th of September. So everything stays the same, the payments stay the same. The one thing that does change is the test time for eligible employees. So the test time now is 1 July and it was previously 1 March. So what does that mean? It means that if you've employed anyone between 1 March and 1 July, those employees may now be eligible for the JobKeeper, both for the current JobKeeper and also the extended version of the JobKeeper. So I would encourage everyone to, look at the employees that they've hired between 1 March and 1 July, because they might be eligible for the August and September JobKeeper payments. So secondly, the ATO will continue to pay the JobKeeper in arrears. So it's a reimbursement. So it's important to continue to pay your employees. Otherwise, you won't be eligible to receive the reimbursement from the ATO. The third element is the turnover decline threshold remains the same. So for businesses with turnover of below $1 billion, which is, most of the businesses on this webinar, the decline is still 30%. And finally, the all-in principle remains the same. So all eligible employees must receive the JobKeeper. So you can't pick and choose just because you can't pick and choose employees. If you have an eligible employee, they must receive the JobKeeper. And the monthly reporting will also continue into the future. Okay, so that's everything that hasn't changed. So what has changed? So there is, as you can see on the screen, so there's a second tranche of the JobKeeper. So from the 28th of September to the 3rd of January, the JobKeeper continues, but the amount that's paid has decreased. So for employees that work more than 20 hours a week, the JobKeeper payment is $1,200. And for all other employees, it reduces down to $750. So the second change, so apart from the amount that's actually paid changing, the other thing that's changing is how it's assessed, or how you can become eligible for this tranche of the JobKeeper. In the previous JobKeeper, you were assessed based on actual or forecasted results, and you will also have the opportunity to assess on a monthly or quarterly basis. For the new tranche of the JobKeeper, that's now changed. So you now only have the option to assess your decline in turnover based on actual figures for the quarter, and it's on a quarterly basis. So you can't assess month by month. It's based on the quarter. So that's the JobKeeper up until the 3rd of January. So from the 4th of January to the 28th of January, the payment decreases again. So for those employees that work more than 20 hours a week on average, their payment will go down to $1,000. And for all other employees, the payment will be $650. Again, the eligibility criteria is the same. You need to assess the actual decline in turnover for the quarter prior to the quarter that you're assessing. So it might be easier. So we'll run through an example. So if we'll move to the next slide. So here you can see, I guess, the two different tranches. The box on the left-hand side is assessing your eligibility for the JobKeeper for the December quarter. And the box on the right-hand side is assessing the eligibility for the March quarter. So for the December quarter, if we assume actual revenue in this example is $300,000 for the comparative period in 2019. Now, that's for both June and September. Now, under situation 1, which you can see there is a decline in turnover of greater than 30% in both June and September. But the important quarter to assess is the September quarter. So because the decline is greater than 30%, so it's 42% there, this particular business will be eligible for the JobKeeper for the December quarter. Again, in situation 2, you can see there that in the September quarter, the decline in turnover is only 25%. And even though the decline in turnover in the June quarter was greater than 30%, this business does not qualify for the JobKeeper in December. The third situation that we have there is, again, the September quarter, this particular business has seen a decline of 50%. And therefore, this particular business qualifies in the December quarter for the JobKeeper. So you'll note that you have to look at the quarter immediately before the quarter that you're assessing to work out if you're eligible. In that first example there, you can see that the June quarter is irrelevant. So it doesn't matter if you decreased by 30% or not. It's the quarter immediately before the one you're assessing. So if we look at the second example there, which is on the right-hand side, this is assessing the eligibility for the March quarter. So I want to draw your attention to the second last column, which says December quarter. That's the relevant period that we need to assess to see if we're eligible in the March quarter. So under situation 1, you can see a 33% decline. So they're eligible for the JobKeeper in March. Situation 2, a 25% decline, therefore they're not eligible for the JobKeeper in March. And the final situation there is a 42% decline, which means that they are eligible. So again, you'll see when assessing the March quarter, the June and September quarters are irrelevant. It's the quarter immediately before the one you're assessing that's most relevant. I hope that's not too confusing for everyone. But obviously, if you have any questions, you can let me know towards the end. So we'll move on to the next slide. So there are still a few questions that the ATO is yet to answer. In the previous JobKeeper tranche, there was some alternate tests because not every business, there were newly formed businesses. There were businesses that had experienced significant growth over the past 12 months. But in those scenarios, those businesses had still been impacted by COVID. So the ATO brought out some alternate tests, and they're still to confirm whether those alternate tests will apply to the new tranche of the JobKeeper. So we will, I guess we'll keep you posted when we get a response from the ATO on those points. It's also possible that the ATO might extend the payment terms for the JobKeeper. They did that at the start of the first JobKeeper tranche. And we expect that they might do it for tranche 2 and 3. So we'll keep you posted on that. Finally, before I move on, I just wanted to, I guess, touch on reiterate, I guess, 2 other important issues, which I've already mentioned. So the test period for employees has gone from the 1st of March until the 1st of July. So if you're currently receiving the JobKeeper, it's possible that you're entitled to more reimbursements in the August and September months. So I would encourage you again to look at any new staff that you've hired during that period of time, because you might be entitled to more JobKeeper payments as a result. The final 2 dot points there, again, I just wanted to reiterate, it's important that you actually make the payment to your staff, because before you get the reimbursement. If you don't make the payment, then the ATO won't give you the reimbursement. So it's still important to make those payments. Okay, so that's everything for the JobKeeper. So I just want to move on to, so we'll go to the next slide. So I wanted to touch on another stimulus measure, which is the instant asset write-off. Now, you may or may not be aware of this particular measure, but from the 12th of March 2020 until the 31st of December, if you purchased an asset that costs less than $150,000, then you're eligible to write off that asset in full at the time that you actually purchased the asset and it was ready for use. So that particular measure is applicable to businesses with turnover of less than $500 million. So there'd be a lot of businesses that would now qualify to deduct that $150,000 threshold in their tax returns. Now, while this particular measure is widely known, the actual excluded assets under this measure, I don't think are widely known. And I guess lately we've seen a lot of businesses think that they're gonna be able to apply this instant asset threshold when in fact they can't. So I've got there on the screen on the slide, you can see a list of excluded assets. The first one there is assets that are leased out or expected to be leased out for more than 50% of the time on a depreciating asset lease. The second one is any assets part of a low value pool, horticultural plants, assets that are in a software development pool, and assets that are capital works. Now, the one that we see the most amount of errors is on that first point. So if we'll move on to the next slide. So assets that are leased out or expected to be leased out for more than 50% of the time. So a lot of times businesses will structure their business to separate the assets that they own from the business operations. They tend to do that as a form of asset protection. But there is an unintended consequence of structuring your business in this way. So, for example, I've got their entity A, which owns the assets, and entity B there operates the business. So under this particular structure, the entity B will lease out the equipment, and entity B leases that equipment off entity A. Now, under this arrangement, any assets that are purchased within entity A would be deemed an excluded asset under the instant asset write-off threshold, and therefore won't be able to claim the deduction in full. I've had a couple of calls recently over the from members in the industry about this particular issue, and they've flagged that, you know, in previous years they haven't known about this issue and they've just been deducting, you know, the assets in full, which is technically incorrect. So I guess I would encourage everyone to just make sure that they're doing the right thing with this particular measure. Now, there is a way to get to still get the instant asset write-off $150,000 amount, but you need to, I guess, it depends on how your business is structured. So if your business is consolidated for tax purposes, then you may still be eligible for it. And that is a way that we've seen people get around this particular issue. Now grouping your various entities for tax purposes can be quite complex, and you need to assess it on a case-by-case basis. But you know, if the dollar values we're talking about are material enough for it to matter, then it's worth investigating with your accountant, or you know, we're also happy to give advice on that as well. Okay, so we'll just go on to the next slide. So if you can't get the instant asset write-off, I guess not all is lost. There are still some concessions. So if you're a business that has turnover of less than $500 million, and you can't use the simplified depreciation rules, so the instant asset write-off, then you can use some accelerated depreciation rates that the ATO has and the government has recently issued. So you're able to claim 50% of the cost of the asset, And then on top of that, you're able to depreciate at the normal rate of the written down value after that. So there are still concessional depreciation rates available, but the important thing to know is that you won't get the full deduction. You'll only get the partial deduction if your business is structured in the way that I discussed previously. Now, again, this issue was brought to us from one of the HRIA members. So I encourage, I guess, everyone, if you have an issue or if you need a second opinion on something, tax related, business related, I encourage you to get in contact with us, and we can, if the matter is something that affects all industry members, then we can bring it to this forum and share it with the other members. So I encourage everyone to do that. So that's everything from me. So I'll now pass over to Todd, who's going to talk about navigating a path. Over to you, Todd.
Thanks, Andrew. Afternoon, everybody. So I'm going to talk about the implications of the changes. So the next slide sort of takes you through at a high level what we're going to work through, which is looking at how we've categorised JobKeeper 2.0 and where that's going. What are some of the macroeconomic implications of where we are, and other factors that are going to come in probably next month and beyond. The likely outcome for those categories of businesses, what's happening in restructuring so everybody can have some reality of that, and the things that we're sort of suggesting for people to navigate and determine options going forward to protect themselves and understand where they're at. So next slide. So basically where we have gotten to is that we've identified three sort of major categories of people who've been impacted by JobKeeper or not impacted by JobKeeper, depending on how their business has been placed. Basically, there are the good, who are zero impact or positive. They're still profitable. They're adapting, and some are winning. Some of them have been positioned very well, and they've been lucky and fortunate, being able to make the most of it. Then there are the uncertain businesses who are probably going to get spat out of JobKeeper 2.0, having been in it for the first round, and but they still have a reduction in turnover. They've got 1% to 29% reduction. They're the ones who are trying to work out what they do going forward. And we'll come to some of the implications for them shortly. But obviously, with a reduction in turnover, you need to change things to be able to protect your ongoing profitability and ability to be able to service things. Then there is those are in trouble who remain in JobKeeper. There's uncertainty around whether there's actually a long-term business there, and that's particularly a lot of businesses we're seeing are sitting in a sort of cryostasis position, particularly in some of the hospitality and businesses aligned with travel and greater hospitality around hotels and whatever else. So they're the businesses that we don't have any certainty around what's going to happen and how that's going to come out the other side, and they're the ones who are probably going to remain in JobKeeper for another 6 months. Many of these entities may fail of keeping in JobKeeper if eligibility is further tightened, particularly if Treasury makes another decision and decides they don't want to spend as much money. So what we have there is a poll question, and what we're trying to do is see where people are feeling. Are you more concerned about dealing with uncertain businesses or the troubled businesses? We're the ones that you're seeing are creating the most grief, and who are you concerned about dealing with going forward in a marketplace where obviously there is some uncertainty about dealing with everybody and whether they have the capability to pay for services and pay for goods. So just wait for that poll to go through. And then we move on to Deloitte's review. Oh, no polls. Sorry, Lloyd. We'll keep moving. We'll come back to it. So in terms of Deloitte Economics have released a statement about a month ago now. It's about around the same time as the government came through, and they have estimated 240,000 businesses could collapse, most of which are in the last two categories, being the uncertain and the effectively JobKeeper continuing ones. The industries are hospitality, professional services. We're seeing it in what we do, and transport are also suffering. Some of the areas of transport are actually doing better, but some of the areas, particularly around people moving, are obviously struggling. What that would mean and how that fits is outlined in that table that we've lifted there. The big issue, I think, is the implication of the unemployment rate, and that has the follow-on effect into the impact of the overall economy and the level of support that needs to be put into it. So there is a large impact here, and that could drive a real deep recession. And that's what we're concerned around is that if a recession is coming through and it appears somewhat unavoidable, that how deep is it and how it can be managed and massaged so that it is not as damaging as some of the previous ones we've had. So that's a summary of the potential impact. The other factors post-September is on the next slide. Eligibility, it's still unclear what will change and how it'll all fit, and I think that will probably adapt as we go forward, as Andrew outlined. The ATO hasn't come to a final position on a lot of things, and now because we've been in a JobKeeper scenario since March and April, there are other factors that need to be considered as part of the assessment. The Landlord Code of Conduct period also ends, and is that going to be extended? I suspect it'll be at least extended into Victoria. We're having issues with our own landlord at the moment, and there are different approaches being taken, but I can see a lot of the landlords are under pressure to be damned if they do and do a deal with their tenants, or whether they don't. So that's going to be another issue that's going to be emerging going forward. Similarly with, I suppose, with hiring of assets and whatever else and things like that, there may well be terms around some of the issues that have been put through in how you've been able to delay or move terms around to make that work. And that also folds into the disclosure requirements with the ASX, with banks and the ATO to keep current arrangements in place. Winding up applications were suspended for 6 months. That's now starting to obviously come to an end. And that period will expire. Are they going to extend it or not? And that could impact significantly a lot of ongoing trading, where people are concerned around whether they can get paid and their ability to be able to recover. So then insolvent trading also is suspended. The government has made some murmurings around extending that and what format that would be. Concerns around that are could mean that if people are not concerned about personal liability, they continue to trade even though they may have issues, and that may pass down the liabilities further down the supply chain, which could create problems. And liability further down, rather than the entity at the top of the supply chain, it is just literally passed down because personal liability is not being respected. Then also the COVID loan repayments, which are now looking, rather than being a 3-year repayment, are now looking like 5. Is the first repayment going to be delayed, and what are the terms on that? That all needs to be worked through. And the bank approach to lending and valuations are obviously now starting to become a real issue as well, with valuers are not known for their anything other than conservatism. So that will impact the ability to be able to borrow, and it'll also impact the bank approach on lending as well. On top of that, the bank being willing to lend or not, that's all sort of working through at the moment because they are becoming more conservative, and it's taking longer to do normal things that would have taken weeks is now months. The ATO approach is obviously a key issue here because there are people who have existing arrangements that need to be extended, and or they have arrangements which are going to arise now. What are they going to do? Are they going to let it play out, or are they going to be more aggressive because they want to recover money? And this all goes back to the factor that everybody is sort of considering is that There's obviously going to be some businesses that do not survive. It's about when and if those businesses fall over and how we can manage that through the economy to make it as minimal impact as possible. So that goes to the next slide, which is, what does all this mean? The good businesses, they're marginal to strong. They have an opportunity to take market share, acquire and expand. So they're in a really good position. The uncertain ones need to make changes, invest to move to good. So it's about getting your investment right and investing in the right areas. Some of the things that we're seeing is moving purely to an online structure and vacating premises and trimming costs down that way. They're reducing headcounts and automating the whole process. And those things take time, they take costs. It's about balancing out that investment to try and get the value and drive that out the other side. There is also a potential servicing risk on loans and other responsibilities if you have an ATO position and whatever else. If you, historically, a lot of businesses have a leverage level, which creates a servicing requirement to the banks and their finance, and they need to be operating at a certain volume to be able to create profits and drive profit. If the market has reduced and there simply isn't enough availability or volume to be able to push that profit incentive, it will significantly impact people's willingness, I think, going forward to be able to sacrifice their time to keep businesses going where they have an uncertainty about whether they're going to be able to make profit. And that's where there needs to be consideration. That's where there will be change and there will be consideration about how that works. But there will be other people who will be taking work to pay the bills and stay afloat. So that's where there's going to be the greatest amount of movement in that uncertain area. There's also opportunity for those businesses to work together and combine and think about things differently. In terms of the trouble businesses, I think they're just going to have to sit and wait. Or if it's determined by their owners or the other stakeholders, the banks and whatever else, that this isn't going to work going forward, that is there any light at the end of the tunnel, or are they going to get run over by the train? They need to either change the way they do businesses or move on and just effectively walk away or move towards a softer landing. Overall, there has been a decline in insolvencies with a slowdown of the formal winding up process and a general freeze on actions. That is starting to heat up as we get closer to September. And there is a feeling in the industry that September and October is going to be extremely busy. There's talk of a wave of businesses falling over then, which will obviously impact pretty much, I'd say, the entire economy. It's about how that is managed and massaged through. And at this stage, there's still uncertainty about how that will work. The best recommendations we can go to probably outlined in the next page about how to massage that. So on the next page. So what we have been recommending is that looking at these sort of 5 things to try and mitigate your risk and understand your risk so that you're protected. So keep your 13-week cash flow with base estimates, be conservative. So that'll get out to beyond JobKeeper 1 and that'll understand where you're going. Try to forecast to 31 December. What does it look like and what is required? Have a look at wages and holiday paid over the closure over summer holiday period, if there is going to be. It's always something that we see catch people out every year, that they get to December and they're just holding on and holding things together. And then they look at it and say, well, we can't pay the holiday wages. So they come and talk to people like myself to work through that. There's obviously a necessity to think differently. Change is being forced on some people. Other people are adopting it and using it as a new way of doing things and doing the things that they wanted to. We'd suggest a look at your systems and look at how you would design the business going forward, looking at your working capital and the value drivers. Along with that is also looking at your supply chain and seeing if there are anybody in your supply chain that you are concerned about and thinking about how you can manage any exposure you have to them. The last thing you need now is to have a debtor who owes you 100 grand falling over because he never had really any intention or ability to be able to pay you, and that value's gone into paying somebody else. So you just need to be able to try and look at those things and massage them. And I know there's a lot of personal relationships involved, but it's just about being aware and thinking about it. And getting a consistent message for the bank and the ATO and understanding where you're going so that you can massage them, and it minimises your time in having to deal with it. So it's a very structured thought process. And the overall is be safe and keep legal issues in mind. There are a number of issues that are going to come out of this litigation level, particularly around how people are managing people on exit. There are because everything is changing and everything is in constant state of flux. I suspect that will create some uncertainty, and people at the moment are still willing to blame other people and look for recovery from former owners and former businesses and whatever else, rather than just moving along. So there could be some of those issues that arise, and thinking about working through each of those changes that you're going through needs to be carefully considered. And that's pretty much it from me. James.
All right, thank you very much for that. I'm just starting my video. Look, it's obviously very uncertain times, and as you said, they're constant change, but we really appreciate the presentation this morning to help our members navigate the road that lies ahead. We do have several questions, which is good, and we'll go through those, so we'll give you a bit of time to respond before going on with the next question. So I'll start over in my little box here. So when assessing JobKeeper eligibility, does the company compare the forecast turnover for the quarter with the previous quarter, i.e. December compared to September, or to the same quarter in the previous year? So would that be one for Andrew?
Yeah, that would be one for me. So you're comparing to the previous year. So I guess that there's two things I want to touch on there. Firstly, you can't use forecast. It has to be actual data, actual results, and you're comparing to the previous year. So, for example, for the September quarter, 2020, you need to compare it to this September quarter 2019.
Okay, well, thank you, Andrew. Along a similar lines of a question, if an employer is ineligible due to turnover in the September quarter, does that knock the employer out for the next quarter? For example, the reduction in the September quarter is 20%, but then for the December quarter, the reduction is 40%. Will that employer then resume eligibility for JobKeeper in the January to March quarter?
The short answer is yes. So if for the September quarter you had a decline of 20%, so not the 30, you won't be eligible for December, but you can still be eligible for March. So you essentially assess the quarter immediately before the quarter that you're looking at.
Okay, Andrew, thank you for that. This is a question that any one of the panelists can take. In JobKeeper 2.0, is there any news on payments to sole traders or directors who are unpaid by wages?
So I can answer that one again. So if a business owner is a sole trader, or they are a director, for example, that doesn't get paid wages, they might still be classified as an eligible business participant, and each business can have one of those. So the rules are the same in terms of assessing eligibility. So you still need to have experienced a 30% decline. And if you experience that decline and you're a self-employed, a sole trader, then you're eligible for the JobKeeper. And if you run through another structure like a company or a trust, and again, your business declines by 30% and you're the eligible business participant, again, you will qualify for the JobKeeper amount. So I hope that answers it.
I think, Andrew, and one of the challenges we've seen is that for a number of businesses where there's two or more directors or sort of joint venture partners working in that way, it can be pretty challenging because only one of them can be that eligible participant. So as far as to date, there's been no change in that eligibility.
Yeah.
Thank you for that one. This one's on assets. Is accelerated depreciating of assets only a benefit in a period when it is likely that the business will generate taxable profits?
Yes. So if you have no taxable profits, then any deduction that you get, it won't make a difference in the current year that you've made a loss, but you will get the benefit of that in a future year if you experience profits. So, for example, if you made a $50,000 loss, and then you also had and that was as a result of the instant asset write-off, that loss would be carried forward to a future year. So if you made a $50,000 profit in the next financial year, then that loss would offset that profit. And again, there would be no tax. So you won't experience the benefit straight away, but you would have it in a future year, provided you make profit in a future year.
Thank you. Still on the subject of assets, if I'm currently planning to acquire some assets in the coming months, what should I do to try and maximise the tax effectiveness of the purchase? Can the write-off amounts be received as a cash refund from the ATO?
So no. So the instant asset write-off isn't a cash. It's not a cash payment from the ATO. It's an amount that goes against as a deduction to your assessable income. In terms of the most, tax effective way, if you're looking into the future. So firstly, I guess I would say that don't buy assets unless you actually need them. So don't purchase assets just because of the deduction, because it's a bit of a false economy, because you're outlaying, a certain sum of money and only getting a deduction up to your tax rate. So firstly, don't buy the assets unless you actually need them. And secondly, if you do need those assets and you're making a taxable profit, then, any asset that you purchase can be written off against that taxable profit in the current financial year.
Thanks, Andrew.
I hope that answers it.
I'm sure we might have another question that it hasn't answered that one in full, but this will probably be one for Todd, as you spoke to this subject. What should I do if I have an important regular customer who has historically been a good payer, but now their age debts are starting to grow?
It's a difficult one because you obviously want to support, and there's probably a relationship there, and you want to make sure that you're keeping your turnover going. But it's about having a pragmatic sort of approach to it. And if you do have concerns, is starting to shorten terms and making sure they are paying consistently and agreeing to reduce any age debt or overall debt and looking at it as a global sort of position. The other thing is making sure that all PPSR registrations are up to date, including obligations around holding money on trust if they are using those goods to generate their own income, and to consider whether you agree a payment structure so that when they get paid, you get paid at the same time, so that there is no effectively risk that you are writing for them. You are only writing the risk of them not getting paid. And I assume with a lot of these things is that there's generally a pull through that if they are getting paid, you should be, it's a lot less riskier than holding on and waiting for them to get the cash and then remit it to you, because generally in distress scenarios, the people who yell loudest and have the most fireworks are the ones who get paid. So I would be looking at that, looking at agreeing a structure with them, and if there is a historical debt, looking at how that gets reduced as well, and trying to get it globally. We often just do a short review of a few of those things for some major clients and say, right, here's how we can do it, and here's how we're working through. We're doing something with a retail client at the moment, which has been 3.5 months worth of work, working out terms of supply so that the January supply can go through to get personal guarantees from directors, making sure the PPSR is in order, and rights to recover all the stock and assets if there is any issues. Depending on what the arrangement is, that can work for hire as well.
Thanks, Todd. Back to the subject of company structures and directors. There's a question on, does a director get a one-off payment of $3,000, or do they get $1,500 a fortnight? I'm not sure if anyone's got any information on that.
So, what they're referring to there is the JobKeeper again, and the eligible business participant. So, if you're the director that is that eligible business participant, then you're entitled to the JobKeeper for the term that your business is eligible. So, if you're currently getting the JobKeeper, so if, let's say you qualify last month, you should get the $1,500 a fortnight up until the 27th of September. And then if your business qualifies in the next couple of tranches, then you should get the $1,200 or the $1,000 after that point. So it's not a one-off payment. You get paid as if you're an employee.
And Andrew, does the director have to? Is it similar to an employee that the director has to have been paid, so then the company will get reimbursed in arrears?
No. So with a eligible business participant, it's a little bit different. You don't necessarily have to be paid the amount to actually get the payment. That is the one unique element of a eligible business participant.
And does that reflect that a business owner may have historically taken remuneration or compensation out of the business in a way other than salary and wages?
Yeah, that's right. So there might be loan accounts, for example, and essentially they're managing their remuneration through loan accounts, and that's correct. So that's essentially why they've done it that way.
All right, well, a lot of good questions today. I'm aware that we're coming towards the end of our session. If our audience has any more questions, please feel free to connect with HLB Mann Judd. They are our accounting and business advisory partner, and as members we can put you in touch. We'll share the contact details of today's panelists after the session. And if at any point in the future you need to contact them, then you can do that through the national office here. So look, that's it for today's session. Just leaves it for me to thank Todd, Andrew and Nicholas, and to all our members as well for joining us. The next webinar we have is scheduled for the 26th of August, and for those of you in the access equipment sector, that will be on mobile elevator work platforms and spotters. So keep an eye out for that one. On behalf of everyone here at the association, we wish you all well. It's difficult out there, and we're thinking of you, and if there's anything that you need, please feel free to contact us at any time. Well, thanks everyone, and stay positive and stay safe. Thank you.
Thanks everyone. Have a good afternoon.